Index funds must buy stocks added to the S&P 500 and sell stocks removed. We measured every change since 2000, 465 additions and 214 removals across 25 years of data. Additions now drift negative after inclusion because the frontrunners got there first. Here's whether you can still profit from it. This is an event study, not a portfolio backtest. Instead of building a portfolio and tracking returns over time, we zoom in on individual events. Each time a stock joins or leaves the S&P 500, we detect every addition and removal since 2000 using the historical constituent table. For additions, we parse the date added field. For removals, we use the remove ticker with the same date, since the removal happens on the day its replacement is added. For each event, we measure abnormal returns at 1, 5, 21, and 63 trading days after the effective date. The abnormal return is the stock's return minus the return of SPY, the S&P 500 exchange-traded fund, over the same window. This isolates the portion of the stock's move that's attributable to the index change rather than the broader market. If the market rallied 3% and the stock rallied 5%, the abnormal return is 2%. We compute the mean cumulative abnormal return along with the median, t-statistics, and hit rates. A t-statistic above 1.96 means we can be 95% confident the result isn't random noise. The hit rate shows what percentage of individual events moved in the expected direction. Events are deduplicated. One event per symbol per date per category. Schleifer proposed in 1986 that demand curves for stocks slope downward. When index funds must buy a stock added to the S&P 500, the demand shock pushes the price up. Harris and Gurel documented the volume and price effects that same year. Chen, Noronha, and Singhal extended the work in 2004, measuring both sides and finding asymmetric effects. The original research painted a clean picture. Additions spike on the effective date as index funds scramble to buy. Then the price holds at the new level. Removals drop as funds sell, then gradually recover. The effect made intuitive sense. If you force billions of dollars of buying into a single day, the price has to move. As of 2025, over $9 trillion in passive assets tracks the S&P 500 alone. Every index change forces all of that money to trade on the same day. The sheer scale of coordinated buying and selling is what makes this effect so persistent in the literature. Our data tests whether it still holds after 25 years of arbitrageurs front-running every change. The addition side first. 465 events, additions now show consistent negative drift after inclusion. This is a fundamental departure from what the academic literature predicted. Think about what that means in practice. You buy a stock the day it joins the S&P 500, expecting the forced buying to push it higher. 1 week later, you're down almost 1% relative to the market. A month later, over 1%. The frontrunners flip the effect entirely. They buy on the announcement typically 5 to 7 business days before the effective date and drive the price up. By the time index funds execute on the official date, the stock is already priced above its new equilibrium. What follows is a slow drift back to fair value. The 5-day result at negative 0.98% carries a t-statistic of negative 3.68. This isn't random noise. The addition side is genuinely negative for post-effective date buyers. Now the removal side. 214 events with price data. The mean removal recovery of positive 7.22% at 21 days looks impressive until you check the median. 4 outliers inflate the average dramatically. SOV gained 591% after Santander announced an acquisition. PCG bats 173% during PG&E's bankruptcy recovery. NCR rose 115% around the Atleos spin-off, and OIA jumped 110%. These aren't index reconstitution effects. They're corporate events that happen to coincide with index removals. Strip those 4 out and the typical removed stock shows a small positive recovery. Nothing dramatic. You're betting on a coin flip that's slightly weighted in your favor. The 53.9% hit rate means you'd be right about 11 times out of 20. A real edge, but a thin one that requires patience and the discipline to buy stocks the market just rejected. The addition effect has inverted since the original academic studies. Front-running now captures the demand shock before the effective date, leaving post-inclusion returns negative. The 5-day hit rate of 44.3% means 56% of additions actually underperform SPY in their first week as index members. That's worse than a coin flip. For a cleaner signal, the announcement date matters more than the effective date. If you can identify additions earlier, through committee announcements or press coverage, you capture more of the move. The removal side offers more opportunity because it's less crowded. Forced selling from passive funds creates temporary dislocations that most traders don't want to touch. Once that selling pressure clears, some recovery is expected. The Nasdaq 100 shows a much cleaner removal effect, positive 5.13% at 21 days, with a t-statistic of 3.29 and a median of positive 2.61%. Why is it cleaner? Nasdaq 100 removals are purely market cap driven. Companies drop out when they shrink, not because of mergers and acquisitions or committee discretion. There's no confounding acquisition premium muddying the data. That 63.2% hit rate is meaningfully above a coin flip, and the median confirms it isn't just outlier driven. Here's how the event count has held up over time. The count fluctuates with market conditions but averages roughly 19 per year. The 2015-2019 period saw the most activity with 24 per year, while the early 2000s saw the fewest at 12. As long as passive indexing keeps growing, reconstitutions will keep creating forced trading events. This isn't running out of opportunity. The effect spans the entire market. Technology, industrials, financial services, and healthcare all contribute meaningful event counts. No single sector drives the results, so you're not taking hidden sector bets when trading around reconstitutions. This is an opportunistic overlay, not a standalone strategy. 20 to 30 events per year means a handful of trades, not a daily system. The removal side is where the data points to opportunity, but it requires buying stocks that just got kicked out of a major index. That runs against every instinct most investors have. The stock looks like damaged goods. The chart looks terrible. Forced selling has pushed prices down and momentum is negative. That psychological discomfort is exactly what creates the dislocation. When there is one, survivorship bias on removals is a genuine concern. Some removed stocks get delisted or go through bankruptcy after leaving the index. If we can't track their price, we lose those data points, and the ones we lose are likely the worst performers. That could bias the removal recovery results upward. Our measurement starts at the effective date, not the announcement date. Some of the price impact, possibly most of it on the addition side, happens between announcement and effective date. We capture only the post-effective portion. Date parsing failures from the free text. Date added field also means some older events are excluded, potentially biasing the sample toward recent years where the front-running effect is stronger. That's what the data shows across 679 events and 25 years. The addition effect has inverted. The removal effect is real but modest for the typical stock. Every number in this video is reproducible, and the full results, charts, and analysis code are on the blog. Link in the description. Track S&P 500 changes yourself at cetaresearch.com. Filter by recent additions and removals, check volume confirmation, and find stocks currently in the event window. Subscribe for more backtested strategies every week.